Hey, what's up you guys? Welcome back to the channel. So today I want to talk about 5 ways you can pay less income taxes. Now, depending on your tax bracket and how much you earn, this can save you easily 30% on your income taxes and also allow you to build wealth at the same time. So let's get into the video and talk about what these are. Now, the first method I have is to actually open up an HSA account. So if you have a high deductible health plan or HDHP plan, you actually can open up an HSA account. And what the HSA account allows you to do is it actually allows you to contribute funds into that account tax-free. Another reason why this account is popular is because it's a triple tax advantage account. And what that means is the money you put in is tax-free, the money you use is tax-free for qualified medical expenses, and it also grows tax-free if you decide to invest those funds, which is highly recommended. Now, each year you're allowed to have up to $3,500 or $7,000 for a family contributed to this account tax-free. And once you reach a certain point, and it's usually like $1,000 or $2,000, any amount after that you can invest into mutual funds or whatever funds your employer has selected for that account. The great thing about this account is it actually stays with you forever, even if you leave your employer. So if you decide to work somewhere else and they have an HSA account, you can always roll that HSA account into your new one or just keep it separate. And also the funds that are in there that you've selected for investing actually grow tax-free and stay with you forever. So not only is that initial investment remain in there, it also grows with you as time goes on. Now let's say you never touch your HSA account and you keep contributing to it. It's going to grow tax-free. And let's say you want to withdraw it at some point. So the IRS allows you to withdraw it at the age of 65. And once you hit the age of 65, it just acts like a traditional 401k or traditional IRA where you can withdraw it and just pay the normal taxes on it. If you try to use it before that, there is a penalty, but if you use it for medical expenses, it's tax-free. So this is a great account to have in your portfolio for retirement. Now, one thing about the HSA is typically the high deductible health plan is a lot cheaper than the PPO or the HMO accounts that your employer usually offers. And so what me and my family did was when we looked at the plan, we just ended up paying the difference into the HSA account. And so for us, it was about $300 to $350 cheaper per month compared to the PPO plan. And we just took those funds and put them in the HSA account. And so we've been doing that for about 2 years, and we have about $7,000 in there. And it's grown since then. And so $2,000 is set aside in the HSA account while the rest is invested into Vanguard mutual funds. Now, if your company doesn't have an HSA account, then the next best thing is probably to get an FSA. And an FSA is a flexible spending account. And this account is very similar to the HSA, except you don't get to keep this account if you don't use the funds. So you want to make sure that when you open this account that you know your medical expenses ahead of time, because if you don't use all the funds, then you're going to lose it. One thing that you want to do is make sure that you look at all your medical bills for the prior year and you kind of estimate, is it going to be the same? And that's what you elect to take out, because when you do your open enrollment, you're going to be asked how much you want. And the nice thing about an FSA is that amount becomes immediately available when that calendar year starts. So for me and my family, we used this in the past when my wife decided to get LASIK. We knew that that was going to be about a $3,000 bill, and we ended up just taking out the max in that calendar year and utilizing the FSA to pay for the LASIK surgery. So in 2020, the maximum amount you can take out in an FSA is $2,750. And while that wasn't enough for our surgery, it was enough to cover most of it, and then we just paid the rest out of pocket. Now, another nice thing about the FSA is you actually can get an FSA Dependent Care account. And this account allows you to put money aside to pay for things like daycare, preschool, summer camp, after-school programs. Now, this account is a little bit different than the other account because you actually have to fund the account before you can actually use it. You don't get that amount up front right away like the FSA medical expense account. The maximum amount for this account is $5,000 if you're married, and so you can contribute up to $5,000 a year to this account to use for that. The next method for saving on your income taxes is to contribute to your company's 401k. So there's several reasons you want to do this, and the first one is usually companies will match a certain percentage of whatever you contribute. So in my case, my company matched up to 3% if we put 6%, so they basically match 50%. Ultimately, that means that if I put 6% in, they'll match 3%. I can get 9% added to my 401k account. The maximum contribution amount for this is $19,500, and that is only your contribution. So you can put $19,500, and if your company ends up matching you, they can match up to a much higher number. So you can end up putting in about $20,000 to $25,000 in here, depending on how much your company matches. And so this is a good way to kind of save a lot of money and also build your net worth and build your wealth inside of your retirement account. The withdrawal age that the IRS allows you to take your money out is at 59 and a half. You also can take it out if you have some kind of emergency or life event. You can look up those IRS rules. You also can use your 401k to take out a loan if you're buying your first house. I don't really suggest you do this because you're going to lose out on some of those long-term earnings. So it's best to just leave this account and let it grow. And then when you're ready to withdraw from it at 59.5, you'll have a nice nest egg. Now this next account is for those who aren't working for another company but are perhaps self-employed. And if you are self-employed, there's a very equivalent account that you can use to kind of build your wealth, and that is a SEP IRA. And this account is very similar to the 401k in that you can contribute up to 25% of your salary to the account, or $57,000, which, whatever is lower. And this account is very similar. You basically put in your money pre-tax and you let it grow, and at the age of 59.5 is when you can withdraw it. So this is just the self-employed equivalent to a company 401k. Now this last account is for anyone who has a company that does not offer a 401k, or has a company that has a 401k that you don't want to participate in. And that is the traditional IRA. The traditional IRA is very similar. It allows you to contribute only up to $6,000 instead of the $19,500. But this account allows you to have full control over what funds you want to buy, what investment strategies you want to do, and that way you're not limited to your company's 401k funds. Like I mentioned, this account allows you to put in $6,000 pre-tax and has a withdrawal age at 59.5. Now there are many other tax advantage accounts like the Roth IRA out there, but this video is specifically talking about how you can lower your taxes for this tax year. Now we'll make a separate video on how to save money on your taxes on post-tax dollar investments, but that'll be for another time. Well guys, that's the end of the video. So if you're interested in content like this, please subscribe to my channel down below. Hit that notification bell so you're aware of when I upload a new video. And if you like this video, don't forget to hit the like button. It really helps my channel out a lot. And if you have any questions, leave a comment below and I'll get back to you as soon as I can. As always, have a nice day.